one speech, and the US dollar lost its gold forever. 1971. A time when bell-bottoms were in style. The Vietnam War was still raging, and President Nixon was busy ending the gold standard. On August, President Richard Nixon delivered an address to the nation, and if you don't know what that means, basically he took the US off the gold standard. From that day on, the US dollar became a fiat currency, backed by nothing but trust. This was the death of the gold standard, and it changed the world forever. In this video, take a look at exactly what happened back in 1971 and why it matters today. Let's start with the basics. Before 1971, the price of gold was fixed at $40 per ounce by law. This meant that if you went to the bank with a bag of dirt, they would give you $40 for it. But of course, it wasn't dirt, it was gold. And that was because gold is scarce. It's difficult to find, and this scarcity gave it value. If something is scarce and difficult to get, people want it more, and therefore, it has value. Think of gold like a rare Pokemon card. There aren't many of them out there, so if you have one, it's valuable. But here's the thing about Pokemon cards, or gold. If something is rare and valuable, people want to hold on to it. They won't spend it. And that's the problem. See, governments need their citizens to spend money. If they don't, the economy grinds to a halt. Businesses can't make money, people lose their jobs. That's not good for anyone. And so, in 1971, the US government decided to change the rules. They said that gold is no longer worth $40 per ounce. They dropped the price to $36 per ounce. And this might not seem like a big deal today, but at the time, it was huge. It was a massive shock to the system. By dropping the price of gold, the US was essentially saying, hey everyone, you can bring your gold to the bank and we'll only give you $36 for it. And guess what? People did. Millions of people across the country rushed to the banks to exchange their gold for dollars. But here's where things get weird. The government didn't actually have enough gold to go around. At this point, they realized they had a bigger problem. They couldn't keep up with all these people who wanted to trade their gold for dollars. And so, they came up with a solution. They just said, fine, let's just trust us. We promise that the dollar will always be valuable. You can trust us. And well, that sounded nice in theory, but in practice, it meant that the government could just print as much money as they wanted. Up until this point, the government had to be careful about how much money they printed, because they needed to have enough gold to back it all up. But now they didn't have to worry about that anymore. They could just print money out of thin air and give it to whoever they wanted. And that's what they did. According to the St. Louis Fed, between 1971 and 1980, the US printed $325 billion. For perspective, in 2020 alone, the US printed 40% of all dollars ever created in just 12 months. Now, all of a sudden, the government can just solve any economic problem with the snap of a finger. If the economy slows down, they just print more money, and boom, we're back on track. Well, at least that's what they thought would happen. As it turned out, printing all this new money had some pretty serious side effects. Side effect no. 1. Inflation began to rise. Remember how all that new money had to go somewhere? Well, eventually it found its way into the pockets of everyday Americans. These people didn't know why they had more money. All they knew was that they had more money, and so they went out and spent it. After all, what else were they going to do with it? Print more money. They took their newfound wealth to stores and bought all sorts of stuff. Now, stores were happy to take the new money, because they could use it to buy more supplies, but they weren't happy about the fact that all of a sudden, they had to pay more for those supplies. See, when all these people went out and spent their new money, the demand for goods and services increased dramatically. Businesses couldn't keep up. They couldn't get enough raw materials to make their products, and so they began raising prices. And this is what caused inflation to surge. According to data from the St. Louis Fed, in 1970, the year before the end of the gold standard, inflation was only 2.6%, but just 3 years later, in 1973, inflation shot up to 8.8%, and it didn't stop there. Inflation continued to rise higher and higher over the next few decades. In 1980, it reached a whopping 13.5%. In 1981, it hit 11.3%, and in 1989, it surpassed 6%, and this trend continued. Today, the average inflation rate in the United States is around 2 to 3%, but outside of recessions, inflation usually hovers around 4%. And while most people think that's normal, that's actually far lower than it used to be. Basically, since the end of the gold standard, inflation has been on a steady upward trend, and all signs point to it continuing higher. Side effect no. 2. Asset prices began to climb endlessly. When people realized that inflation was getting out of control, they panicked. They didn't want to hold on to cash anymore. They knew that if they kept their money in a savings account, it would quickly become worthless. And so they began buying assets, anything that could potentially go up in value. At first, people flocked to housing. The median home price rose from $25,000 in 1970 to $61,000 in 1980. That's an increase of 144%. Then people moved on to stocks. Between 1970 and 1980, the Dow Jones Industrial Average increased from 844 to 869. That's an increase of 38%. And then people bought commodities. Gold, for example, increased from around $35 per ounce in 1972, $400 per ounce in 1980. And this trend has stopped. In fact, it's only gotten worse. According to some estimates, since 1971, the stock market has outperformed every other asset class, including real estate, bonds, commodities, and even inflation. And this is a big part of why the rich are getting richer. See, the richest people in the world own the vast majority of the world's assets. And since assets have been outperforming cash by such a wide margin, the rich have been getting insanely wealthy. At the same time, the middle class has been completely gutted. Since the end of the gold standard, the median income in the U.S. has barely budged. Today, the average American earns about the same amount as the average American did in 1970, but the cost of living has skyrocketed. The average home costs 5 times more. College tuition costs 6 times more. Healthcare costs 9 times more. And groceries cost 7 times more. This means that even though the average American is making about the same amount of money, they're far poorer than they were in 1971. So now we come to the final side effect of the death of gold. And that is, inflation is surging again. Just a few months ago, the government was saying that inflation was under control. In fact, they were saying that inflation was great. It was helping the economy. But then something unexpected happened. Inflation started rising faster than expected. The government tried everything they could to combat it. They raised interest rates. They sold off oil from the Strategic Petroleum Reserve. But none of it worked. Inflation just kept going higher. And today, inflation has reached a new 40-year high. It's at 9.1%. And this isn't just a blip on the radar. Most economists agree that inflation will stay high for the foreseeable future. So now people are starting to realize that the trust in fiat money is fading away. More and more people are beginning to see that the system is broken. They don't trust the government anymore, and so they're selling. They're selling their houses, their stocks, their bonds, and they're buying things that actually hold value. Bitcoin has surged in popularity. Gold and silver have seen record demand, and there's even been a resurgence in the use of crypto. Basically, people are fleeing to assets that can't be inflated away. They want things that have real value, and that's why